Okay, we have gone live. Good evening, everyone. Thank you so much for joining in. It is 7:30, and maybe we'll wait for a couple more minutes before we start. So I can see a few people joining in. Can you all hear us clearly? Can you all see us? If you could just give a thumbs up or say where are you joining from, it will be great. So I can see a few people joining in. Can you all? Okay, I can. I got a couple of confirmation on the phone that they're able to hear me, not on LinkedIn. Let's say. Okay, so it's 7:20. Okay, thank you, Simadri. Nice to see you. Great. I hope you're enjoying the Bangalore heat, like we are all enjoying, Simadri. Thank you so much for joining in. And again, it's been some time since I, did this AMA plus a launch session. I took a break because we wanted to bring in something new for all of us, investors, and so I thought this is a right time for us to introduce a slightly different sort of a portfolio, which in general I've not seen a lot of people doing right now in the market, which is a little aggressive portfolio, which is a portfolio that talks or invests in flavor of the season, right? What do you mean by flavor of the season, right? Um, in general, what we have seen is that markets moves in cycles. Some sectors do very well, and some sectors don't do as well, right? So, if you're an investor and if your money is managed by people like us, we just don't focus on managing your core of your portfolio, which is investing in equity for long term. We also, being in the virtue of investing actively and watching the markets very actively, we would like to bring in certain opportunities that are not very long term in nature, but have the potential to add significant amount of returns on your portfolio. It can create a decent size return, or add up to your overall portfolio returns. And that is what our focus will be this year. We will build your core portfolio. We will build you or help you build a large cap, mid cap, and other kind of portfolios, flexi cap portfolios. But the flavor of the season portfolio has a different objective altogether. It will focus on sectors or themes. For example, consumption as a theme did very well after COVID. So if you had invested, your returns could have been a lot higher than what the markets could have given. PSU, right? We all saw how PSU went through the roof a couple of years back when it was undervalued, right? As a season, maybe we could have bought it as a flavor of the season. Like last year, even small cap could have been a part of your flavor of the season because it was so undervalued that it was quite obvious that we should be adding that as a part of your portfolio. So our entire aim going forward in this year is to give you different sort of wealth baskets or portfolio of funds that are a little more aggressive in nature, but with a little more tactical, and that makes good some opportunities, right? So now that I've given you the context, I want to introduce you to Naveen Shetty, who's a co-founder of Mira Money and also the CIO of the firm, and Mohit, who's a part of the founding team and heads the investments. So how we have made this is Mohit will present and talk about the flavor of the season this season, right? We'll talk more about that. Naveen will also be answering few of your questions along with Dai, and see by the end of the session, if you like our theme, you can actually go ahead, download the app, and invest in this theme straight away. So, welcome, Naveen and Mohit. I'll start the presentation now. Let me just see if there's any other. Okay, good. So I've already briefed you on what is the flavor of the season. What does actually mean? For example, if it is summer, we know that it's a season of mango. Similarly, today, the season that we believe, or the flavor of the season may be something that we benefit out of a certain event. Let me talk about the investment process first, and then introduce the flavor of this season. So it is very high on risk and of course the reward, right? So because when you're going to go very, very nitpicking, picking one sector, one theme, it in general is little high on risk. And of course, if the risk pays off, the reward is also significantly high. And it has got a lot of momentum build up in it. In the sense, this is not something that you're betting that it will do well in the next 6 years, 5 years, 2 years. No, this is a strategy that is already showing you momentum, right? And that is the reason why the investment duration is not like it will be there for 3 years, 4 years. The general investment duration that we expect is about 6 months, at least. Sorry, not 6 months, but 6 months at least. And it can go up to 2 years also. But we don't see this as a strategy or the flavor will last for months or years together. We expect it to, slowly die down in the next 2 years, and then some other flavor will take over. And this strategy, as I said, we are going to nitpick. It'll be investing in sectors, it'll be investing in factor funds, it'll not invest in the regular large cap fund or a mid cap fund, and we'll try and avoid as much as possible. So, this is the flavor of the season as a concept. Now, what do we or how do we arrive at the flavor of the season? Because there are so many events happening in India. How do we believe that, okay, for this season, let's build this portfolio? There are three basic strategies that are part of our selection criteria. The first is there a change in market cycle? So, for example, like last year when IT fell, I'm just taking a random example, IT fell, maybe it was a sector shift. We could have actually gone ahead and invested in IT to make 30-40% return also, just an example. Or you see a certain sector benefiting out of a certain action taken by the government or the company in itself, right? So we look at the cycle changes and what are the factors that can lead to stock market changes. Like PSU changed the entire game 2-3 years back. Small cap changed it last year. Consumption changed it after COVID. I'm just giving you recent examples. Similarly, is there any market cycle changes that we are observing? The second and the most important, in my opinion, is the sector undervalued or rightly valued? For example, um, let's say chemicals. A few years back, chemical as a sector itself was showing a lot of earnings growth. The company was doing very, very well, but the price didn't actually do as well. And that is when we spot it and we say, okay, now is the time for us to go and invest into a chemical sector fund, if at all, if it is there. I'm just trying to give you an example. Or where we see earnings revival, or we see there is a significant growth in earnings, that is when we go and invest into, or at least make it a part of our selection. And the third is government policies. For example, in the last 5, 10 years, there are few changes in the policies which is leading to significant amount of money flowing into that sector. It could be semiconductor, it could be infrastructure, it could be multiple things because of government policies. It will come and impact that sector in particular, and that is one of the reasons or one of the selection criteria for us. So it's more momentum based, earnings growth based, and government policy based. Yeah. So now, we all are in the midst of election. 2 phases are already over out of the 7 phases. So we thought it will be the best time for us to launch a flavor of the season which will benefit out of what is happening as an event. The event is election, and the flavor of the season is if election turns out to be, what are those sectors and themes that will do well if at the end of election period. There's a broad theme. Of course, Mohit will talk a little bit more about the theme. But let me talk about the impact of election and why it is important, right? There's a lot of focus on election. You see, the entire media is talking about India election. You see, US is talking about their election, and when the UK election, very important, because in general, post-election, you expect the reforms, if they are good, to continue. Either you vote for a change or you expect the continuity in reforms. That's why elections are a key indicator for markets. And if there are developments, so for example, the current government's focus is more on infrastructure and manufacturing and many other things, right? So what are the kind of focus that the earlier government or the previous government had, and how will that impact post-election? That will be determined only after election. General FII and DII investor sentiment. These are the 3-4 factors, or these are the 3-4 places where election will have a deep impact. Now, I'll stop here. I'll ask Mohit to introduce election as a basket, the process behind doing election as a basket, and of course, be open to any kind of question that you will have as we move along. Over to you, Mohit.
Thank you so much, Anand. So, as part of the process of understanding the election basket, what we tried to do was focus first on what the ruling party is speaking as part of their manifesto. So what we did was run through their entire manifesto, understanding what are the key focus areas which they have in mind for the next 5 years in place. So this slide speaks about what is clearly the vision coming out from the BJP's manifesto is making India the manufacturing hub on a global front basis. So that is basically the China one positioning, and they are pretty dead serious on getting this thing done in the next 5 years. The second point which mentions is the BJP manifesto promises continuity of the reforms which they have been doing for the past 10 years, which will also be accompanied by the enhancement of those policies when it comes to railways, roadways, or the aviation segments which they are working on. A bigger mandate here will foster more confidence in the domestic and the international investors, as Anand mentioned in the previous slide also, which will lead to a bigger uptick in the capex cycle. Now, what is capex cycle? Basically, is the public sector, the government itself increasing the capex along with the private segment, making the capex cycle furthermore increase during the next 5 years. So that is something which the focus will be of BJP, and that will lead to a public lead led by the private sector increasing their capex cycle. The segment which they are focused on, as I mentioned, is railways, aviation, affordable housing, pharma, electric vehicles, and renewable energy. These are the key criteria, key segments which they have highlighted, and there's not too much of focus on the other areas. So these are the primary areas which BJP wants to focus in the coming years. So I'll just run through the key points which were there so that it gives you an overview. What are they planning to do? So if you see the highlighted ones, it clearly shows that it's not, they want India to be just a player in this segment, but become a global leader in this segment itself, strengthening position in the pharma, automobile, railway, and the manufacturing side. So there were a few data points which we were going through in terms of in the last 10 years, what has happened from a manufacturing point of view. So what is clearly coming out is the cost of labor what India has as of now, it's gradually reducing to an extent that it is second in the Asia segment itself. So the cost of labor being so cheap makes India a very good hub for the global players to come and invest, because that's going to be a major player going forward. So the in automobile is where they want to focus: semiconductor, pharmacy, shipbuilding, railway manufacturing, and being a leader in the textile manufacturing also. So this is primarily on the manufacturing side is what BJP has focused. I'll go on to what they are focused on the infrastructure side. Now, while in the last 10 years, we have seen a lot of things have changed. We have seen Vande Bharat coming in, the roads getting developed at a faster pace, the metros coming up at a gradual pace in a lot of tier 1 cities and tier 2 cities also. What they have clearly mentioned as part of their plan in the next 5 years is adding 5,000 kilometers of new tracks every year. redevelopment of 1300 railway station, initiating metros in 20 plus cities, and extending the PM Gram Sadak Yojana, which will connect the remotest city or the village in the country. So that is where the focus is lying on the railway and the roadway side, followed by the aviation and the port segment, where they want to create new airports, which you would have already noticed in UP itself. The number of airport which has increased in the last few years, they are aggressively planning to get more airports in the northeast section also, and also on the on the eastern front of the country. So that is something which they are focusing on the airport segment, and also on the port side. If you have noticed that a lot of porting activities are happening on the western regions, along with the Kerala port, which is getting developed, which is going to be a mega changer in the coming years. So this is the focus on the manufacturing and the railway side, manufacturing and the infrastructure side, which BJP is focusing. Now, there is a point that, okay, BJP is going to be the, let's say, is going to be the front leader in this election. What if the election goes the other way around, or it's not in favor of BJP, let's say? So we focused on what is the opposition party's manifesto also speaking about. So the clear cut points which are coming from an economy standpoint, they're focused that increasing the manufacturing share in the GDP from 14% today to a 20%. Now that's a very big jump when we have three key segments as manufacturing, services, and agriculture. So a clear cut indication by the opposition also, which is Congress, saying that manufacturing is going to be their prime focus area going forward. They want leadership positions in industries such as auto, pharma, textile, cement, and electronics, similar to what almost BJP also spoke as part of their manifesto. Target specific PLI sectors so as to increase the jobs thereby. So that is something which they are trying to focus on the infrastructure and manufacturing side. The points which I mentioned below is the same: modernization of the railways, promoting renewable energy, and boost up the private capex. So clearly, both of them might be on the other front, on the political front, but on the economy side, they're primarily lean towards the similar kind of a focus areas. So clearly, what comes out, as Anand gave a hint, that the flavor of the season for this time is primarily led to the elections, which is focusing on manufacturing and infrastructure. So there will be a few questions around the downside risk. If, let's say, the government does not come of the ruling party again, what are the downside risks which we can see? But there's one critical question, which I guess if a lot of us have been investing, is we have seen in the recent period, in the last 1 year, there has been a decent rally of around 62 to 54% in the infrastructure and the manufacturing space. Now, I just want to give a few points what has led to this increase in the last 1 year. So market returns is a factor of EPS growth and price to earning. So the last 1 year, we have seen a steep, but it is primarily due to the fundamental rally, because the EPS growth has been the key reason for the run up. If you see the chart, what we have tried to show out here is 62% of 1 year return is because of the 62% EPS growth which has happened in the infrastructure space. The PE has marginally increased by 0.5% only. In a manufacturing space, the 54% return is because of 34% coming from the EPS growth and 15% from the price to earning growth. So this clearly gives an indication that, because a lot of people worry that it has already run up so much, should I get into this segment or not? However, market returns is a factor of how the EPS growth is going to be going forward in the next 1 year or a 5-year period. So from a standpoint today, what we feel is the price to earning hasn't increased so much. It is primarily the EPS growth. And going forward also, that will be the key indicator to determine what kind of a growth trajectory we might have in the short to or long-term period also. So thereby, infrastructure and manufacturing space, with the expectation of further focus by the ruling party, will be the key focus from our end. Just last few points of the current risk which we can have and what are the mitigants around it. So the risk at this current juncture is more global than the India macro scenario, because there are war kind of scenarios. There is also the inflation which is peaking up in US and the European front. Those could be the risk which might impact the portfolio But it is not just the infra or the manufacturing portfolio per se will get impacted. It is going to be the larger, broader markets also. So the geopolitics, inflation, and the interest rate worries will be one of the risks which will be there, and that might impact the overall portfolios. Now, some potential risks with respect to the specific segments itself, the unexpected election results. There is a focus, as I said, from both opposition and the ruling party. So no matter even if the unexpected results come around, you will definitely see some kind of a surprise, as you would have seen in the state elections in the recent period also. The markets do get a correction, but they bounce back. As I said, EPS growth will be the key indicator to determine what kind of a returns will be followed through. Second thing is the slowdown in the global or the domestic GDPs. Now, India is emerging as one of the largest source of cost-effective labors. So, the slowdown in India is not expected to be so less that it might impact the markets too significantly. Now, there have been a lot of analysts on the global front also have clearly indicated what kind of a growth trajectory India is going into. So definitely from a manufacturing value proposition, India is one of the space which will not be ignored, especially when China is facing a lot of issues. So you will continue to see good growth in the domestic segment itself. The third point is the slow pace policy implementation. Now, government, either the ruling or the opposition policies for infra and manufacturing are more favorable than any other industry. So even if the policy implementation is slow enough, they will not be ignoring the infra and the manufacturing space. They might go down with respect to banking or any other segments of the market, but this is clearly something which they might not slow down immediately. The last one is the geopolitical development. So India continues to be focused from a diversification point of view. They are creating connections with the other countries, so that is helping them uh, from an import point of view and from an export perspective. It's not that it's inclined towards specific countries itself. So efforts towards making more partners is helping India specifically. However, there's a lot of effort which the government is taking towards localization, which is creating an import substitution. This morning itself, we were talking to one of the fund managers, and this is the element which he mentioned specifically, that India is creating import substitution, which is going to be very handy when there are a lot of geopolitical distress coming. So India being Atmanirbhar in that sense will create a lot of opportunities, not from just the job front, but from an economic development point of view also. So these were the current risks and the mitigants which we feel might have in the portfolio, but the mitigants will help you gather the portfolio returns as soon as the bounce back comes in. So I'll just hand this over to Anand to summarize what we just spoke about.
Yeah, thanks, Mohit. While yeah, there are the thing I want to first talk about is we are focusing on two primary investments. One that will help you to invest in infrastructure. The second is that will help you in manufacturing as a theme. Um, we also are seeing that a lot of companies in India, which are industries rather, are already running at close to about 75% plus kind of a capacity. Plus, the good thing that we also see is a lot of them are also very low on debt. In the sense, earlier, I remember 2017, 18, the focus was to reduce the debt for companies, and today the focus is to ask them to borrow more so that they can invest in capacity, and then that can lead to better manufacturing spaces and stuff like that, right? So these two pointers, and along with the cost factor that Mohit was mentioning, is a good indicator for us to look at manufacturing as a theme. Plus, we are also already seeing it. It's not that we are the only ones seeing it. If you see the number of company registrations that are in the manufacturing space, thanks to the SOPs that are offered by the government, it has already gone up from 21% to 28%. Plus, a lot of FDI investments are also coming in a big way in the manufacturing sector. So the trend is already pointing out towards making India as a manufacturing hub. The China plus one strategy is working well. Now, what will happen if there is a change in government? It could be BJP, it could be somebody else. But if there's a change in government, we are all sure that there will be some bit of a market correction. And if that were to happen, like what Mohit was saying, the last few years, the growth in these sectors have been because of earnings growing and not because of valuation, which is the PE, the price to earnings multiple growing, right? Yes, earnings will continue to grow. The only thing is the valuation at which somebody was valuing us earlier and now may change because of change in government, and any change is not many will like changes, right? So that can lead to a bit of correction. The PE will come down while the EPS will continue to be stable or growing. So if it falls, you should also use that opportunity to buy, because when things get back to normal after the fall, you will see that you have actually made a lot more return than what you would have actually expected today while investing today. And the focus of both the opposition and the ruling party being on manufacturing and also on infrastructure is a good positive for us. So once the election results are announced, you will see post which there will be a budget announcement, and that could lead to significant rally in these two sectors, plus good growth in the earnings of these sectors itself. So these two put together, we believe it's a good time for us to add funds that primarily invest into infrastructure and primarily invest into manufacture. And we have already built that ready made for you. And if you're an investor, if you've already downloaded the app, you can just see we have already launched something called a satellite tab. Click on it, you will be able to see the fund details, and you can actually invest as low as 25,000 rupees and make this work for you, right? So with this, I will stop. I'm sure there will be some questions coming in. I have a couple of questions already on the other channels. We are open to questions. So if you have any questions, please feel free to ask us, ask Naveen and Mohit as we progress along. Okay, now, one second, I'm just trying to see the questions. Any questions on LinkedIn, please feel free to ask, and then we'll be happy to answer. Okay, the first question is for the investment team. Again, thank you, Naveen and Mohit, for working very hard to build this. So Naveen, the question that I have is, so who is this portfolio suitable for? And if it is suitable for someone, what should be the ideal allocation in this as a concept itself?
So generally, this portfolio is suitable for somebody somebody who has already a core portfolio, uh, which is a broader portfolio of stocks and other assets based on the risk category. This is a portfolio which comes under a satellite section of your portfolio, wherein it is it provides zinc to your portfolio. This is a high risk, high reward investment. You're taking some chances here. Generally, in a core portfolio is something which drives your long term life needs. Uh, this is something which can give you a immediate boost, or it is a bit excess risk you are taking. Uh, the risk plays out, then you don't lose much, but the reward plays out. It can then at a later point you can reallocate it to core partially or move into another theme which is there. So typically around 10% of your portfolio into this would be a very good idea.
Okay, so you
Yeah.
mentioned 10% of your overall portfolio in these. So, okay, I'll ask this question. Is this only 10% in the satellite as a concept, or 10% of your portfolio into election as a basket, or the flavor of the season as a basket?
So generally uh, around 20 to 25%, depending on your risk profile, you can have it in a satellite portfolio. So
Got it.
half of that satellite portfolio you can have this thing, wherein you can move around as and when you feel, which this can provide you. All of a sudden, if you say, if you had bought uh, infrastructure or infrastructure or manufacturing last year, you would have earned around 50% returns, right? Uh, so then what you do is after a year, if that is not the theme, then you can shave off 40-50% of that and move it to core. So your portfolio will will still have uh, around 10% of it as a risk element. uh, this is something which it is an actively maintained portfolio, uh, which you take strategic decisions on that.
Got it. Okay, one other question that has come is, okay, you one second. This is from someone on YouTube. Okay, the question is, you you have covered the downsides of the portfolio, which is provided, the basis the election. But his question is, what if it doesn't take off? So his question is, so you are projecting two sectors that can, or segments that can do well basis the manifestos and the views of the government. I'm just reframing it. But tomorrow, the government itself changes its focus, right? So what happens to these sectors? Because I've already invested 10% of my money here.
So uh, let me address this, and probably Mohit can add more to it. So this is a portfolio. This thing, and obviously any other portfolio with us, we actively keep watching. And uh, if things don't play out, we evaluate all our portfolios. uh, we do a long term evaluation of all our portfolios every month, but we keep watching every week too how things are going, and obviously track it every day. Uh, so so if things don't turn out here, god forbid something wrong happens, we will be cutting our losses and moving to the next flavor.
Okay.
So that is something which we will keep a keen eye on. Uh, Obviously, I mean, everything we planned for the worst case, but there are things which can happen even worse than worse, and we will have to pull the plug. And I have been investing in the stock markets for close to 25 years now. uh, it is very important to cut your losses and run, because if you have a well diversified portfolio, you will make your money in other places. So that is the theme. And one of the focus of our investment team is always, if you see any of our presentation, we always cover the fact that what if things don't work out, what if things go negative. We always think about that. Mohit, you want to add anything?
Yeah, basically, I second the thought which Naveen said. From my point of view, it's like I don't want to marry the investments where I'm doing, right? If the things are not going the way it has to, you need to cut down your losses, get into the segments which can decently grow going forward. And that's the view. You don't need to be biased with your judgment. So that is something primarily from a investment analysis perspective, what we tend to do is it's more on data is what we tend to believe and not on our guts. Okay, so we do our research, our analysis backed by data, and if the data speaks in favor of a decision of either entering or exiting is what we then tend to do. So yeah, as I said, don't want to marry the investments where I do, where it has to be cut across. I'll go through the next investment then.
Okay, so yeah, if there is a need for a change, our investment team will make the change as what is pointed out by Naveen and Mohit. Other question that has come is, one second to read that out. So I'll just rephrase it. So the person is asking this question saying, was election the only theme that came out when you did this analysis, or you did it because it is election period? I mean, okay, let me put it this way. Right? I'm assuming this is, please correct me if I'm wrong, but did you have any other flavor also while when you did this analysis? But you chose election because it's more apt at the moment.
Uh, so so the way we do our satellite portfolio is, we obviously look at each sector, uh, how it uh, how how they are valued, and is there any scope for further growth. And we constantly, as our investment process, we keep doing that. And we also look at what might be the headwinds and tailwinds for that sector coming forward. So we do data crunching, and one other thing we do is we directly talk to the fund managers constantly of all the funds in the sectors, all the popular funds in the sectors, and we collect those feedbacks. We make notes on that, we do analysis on that after the call. And then, so in that process, what came out is manufacturing and infrastructure can have a good chance because of the elections. Um, we first started with the current government continuing. So what happens? uh, that was an addition added. Then we give marks to that, telling, okay, this is what we can get if the current government continues. So from our point of view, though we are telling elections here, our main focus is the July budget which is going to come out. That is what, and that clearly, the finance minister has already told, and it is all available, that manufacturing will be their focus. And uh, so so and apart from that, uh, from all our analysis and talking to fund managers and even economists, what we figured out is pushing manufacturing is is no brainer, no choice. India doesn't have a choice for it to grow to the next level of growth. I mean, the aim is to be the third economy in another few years. To go there, manufacturing has to be an emphasis, and also to take care of so many uh, youth who are coming out into the employment pool. Manufacturing is the need of the hour. So that and infrastructure. And then we did the worst case scenario of, okay, if things don't work out as planned, how does it work? Even there we saw some glitches, but at the end of the day, the focus has to be on this. So yes, election, this is how we picked election as the criteria, because primarily because after election, the budget which happens is going to be the big bang for these two areas. I hope I answered your question, Anand.
Yeah, yeah, yeah. So that's a good description. Now, yeah, in fact, thanks, Mohit. That was the next question that somebody had asked me. So the question is, what are the funds in it? I mean, so how do I go and invest into an election or a season of the flavor of the season basket? Plus, what are the kind of funds in it and what are the minimums, right? These are the three questions. Maybe I'll just answer that question. Thanks, Ram, for asking it. So, if you download the app, you will see that on the front page itself, we have made it very easy so that we don't keep it somewhere in the corner. Right on your face, you'll be able to see three big tabs. And on the top of it, you will see core baskets, which has got smart debt, moderate growth, and high growth. Mohit, if you could just point out. And then you would see the satellite as a basket, which is very, very recently launched, which is as late as yesterday. In the satellite basket, our aim is to launch more and more, little more aggressive strategies than the core basket. So in the satellite basket, you will be able to see season's flavor or flavor of the season basket. And today, if you click on the invest, and if you have done your KYC with us, and if your KYC is validated, it is very important that you validate your KYC and all this stuff. If it is done, then the minimums are 25,000. You'll be able to see the fund details. We have done a 60-40, 60% into one fund and 40% into the other. You'll be able to do, see that and invest, and the basket starts working for you, right? If there's anything that I missed, Mohit and Naveen, you can add that. Otherwise, I can move to the next question.
No, that was perfect.
Okay. 1 second. Let me see this question. 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 Can you repeat the EPS slide? Okay, the question, Mohit, can you show the presentation? And somebody wants to understand that EPS, the valuation, yeah, is there a downside after the recent rally? So I'll explain that in maybe couple of minutes. So the question is, uh, a lot of people ask, right? It is the infrastructure manufacturing as a theme has already run significantly. Isn't there a downside risk to it because it's already gone up so much, right? It is similar to markets have already gone up so much. Is there any meat left? And if there's a meat left, how can I make the best out of it, right? So I will split this again. I'll spend about 2-3 minutes on this, so please bear with me. So market returns are actually determined by two important things, and the most important thing being EPS growth, which is earnings per share growth. At the end of the day, as you all would have known, and it's already repeated multiple times, markets are slaves of earnings. A company is a slave of its earning. So you pay a price today to a company saying, okay, Mr. X is a listed company, let's assume. Mr. X, I'm going to buy you at 100 rupees because you're expected to give me a growth of 10% every year for the next few years, just as a random example, right? That's why I'm paying you a future expectation, I'm paying you a price today. So if the earnings that he's going to give you, Mr. X is going to give you is very high, then the price at which you bought is a little low, then you're going to see significant rise in the price, right? So market returns are determined by two factors. One is EPS, earnings per share growth, and what is the valuation or the price that you're paying for that growth. If you're paid a great price already, and if that earnings happens, even after that, you will not make great returns. But if you're paid a bargain, like last year, small cap was available at a great valuation, but the growth was expected to be good. So if you had paid a good price for a great earnings per share growth, your returns can be splendid, like what happened with PSUs earlier, like what happened with small caps earlier. So now let me focus on infrastructure and manufacturing, right? Infrastructure, the last 1 year return of 62% is not because you have given higher value. It is purely because infra as a basket, the kind of companies that are there in the infra index have grown their earnings by 62%, close to 62.9%, which means you have only the valuation has not gone up at all. The 62% growth is only because earnings have gone up, which means tomorrow if they continue to do this kind of a growth, of course 62% is impossible, but even if they continue to do 15-20% kind of growth, the price is already showing on the price is very, very stable. You can see significant growth going forward also. While in the case of manufacturing, it's a mixed bag. 54% return has come from two bits. EPS growth is at about 34%, and PE growth is at about 15% or so, which means the valuation has also gone up. Earlier, somebody was ready to pay 100. Today, the same person is ready to pay 115 for the growth that he's seeing. And also, the earnings have gone up by 34%. If the government's efforts continue like this, you would see that EPS will keep growing and growing and growing. And that could lead to both EPS growth, of course, and to PE growth as well. So what we believe is because it is driven by fundamentals and not because there is liquidity gush towards it, there is good amount of room going forward also. This is not like a 2008 where there was FIIs coming and buying any goddamn share that you can think of. This is purely because of proper earnings growth that these sectors have seen. And that is why we believe the downside, of course, there can be some downside, may not be significant because it is driven by fundamentals. I hope I answered that question, Ram. Thanks for asking that question. If okay, maybe we'll take 2-3 more questions. Yeah, if there are any further questions, you can download the app and ask us. You can chat with our customer success manager. She or he will be able to help you here. So that this basket is already live. You just have to download the app and see. Okay. 1 second. We'll wait for a couple more questions. Okay, there's one different question altogether, not related to this. So markets are already trading at all-time highs and around all-time highs. So Naveen, if you could just answer this question saying, what do you foresee from here? Let's forget that there is an election event. So what do you foresee? Are you overvalued? Are you rightly valued? Are you undervalued?
Yeah, so we, as a part of investment team, we regularly look at what the current valuations of the markets are, and and just a few days back, I think couple of days back, when we did the analysis, we ourselves were surprised. This is when uh, Nifty 50 had hit 22,515 or something. It was almost close to the high, or it was the highest. Uh, at that time, when we did the valuation check, the valuation came almost close to what the current market price was. So, which is I mean, a month back, a month or two back, uh, I think in probably in January or something, when the three state elections happened, uh, all of a sudden the market ran up, and uh, there was a sense that the markets were paying extra the for the current government to come back, which means there was a bit of overvaluation there. Now, within a quarter, the earnings have caught up so well that the valuations now, there is no extra valuations, at least in the large cap, for the uh, for there is no election premium in the valuation. So it is right now at the right price. If And surprisingly, what has been happening from the past uh, 8-10 quarters is uh, India's earnings growth has been going up like clockwork. It is being doing better than expected in some quarters, or meeting the expectations, never been below expectations. It is it is it is such a well-oiled machine right now. In fact, it's so surprising. So net, the valuations currently in the large cap is at on par. Uh, so so you're not paying anything extra right now if you're buying large cap. Markets going all time high. I mean, that is the nature of the market. Since the markets follow, at the end of the day, it follows earnings. And India being a growth country, uh, the companies which have figured out the formula to run a good business, they keep growing their earnings. Uh, and if they don't do that, they fall out of the index. So it is always expected to keep hitting all time highs. So I think all time highs is the nature of the market. It will keep happening, especially in a growing economy.
Okay, so got it. And maybe this is the last question. If there's any more, I'll answer. Um, so because somebody saw smart debt, right? What is in smart debt? What's your view, Mohit, if you want to answer that question? What is smart debt about?
Sure. So this is a very tactical strategy which we have placed. It's in a way you can call a season's flavor from a debt point of view. Uh, a smart debt here, what we have tried to create in the portfolio is playing the long duration portfolio on the debt side of it. I'll just give you how does it work. Now, what we have seen in the recent period is the interest rates had peaked up in India to a 7.5% for a 10-year GSEC. Similarly, in the US also, it has peaked up to a 4.5%. Now, what happens in the debt markets is when the debt yields from a 4.5, or in India 7.5, it starts to fall back to, let's say, a 7, 6.5, which is the usual routine where it should be. Because if the inflation is in control, these yields should try to come back to 6.5 or 6%. Now, this is going to be a normal trajectory going forward when inflation comes in control, both in India as well as in the global space. Now, what we have tried to do out here is the expectation of the inflation trajectory where it is going to go down in the few period, like 1 to 2 year, it is expected to go down. The interest rates are also supposed to follow it from, as I said, from 7.5 to 6.5 or 6%. Now, that has been the range of the Indian 10-year GSEC for a very long time. The increase was due to the inflation scenarios. Now, in a debt market, whenever the interest rates fall, that is when you gain in the portfolio. That is your NAV change or a MTM, which is your mark to market gains. Like how you see a Nifty increasing from 100 to 200. Similarly, in the debt space, whenever the debt yields fall, you will gain on the NAVs also. So whenever you are on the longer tenure, let's say a 10-year tenure, and if you have a 1% decline in the interest rates, let's say from a 7.5 to 6.5, so the 1% decline which has happened into the period, which is your 10-year period, that will be the MTM gains which you will get in your portfolio. So this is a similar strategy what we have tried to place in the smart debt portfolio, where we are expecting in the next 1 to 2 years the interest rates to fall, and when it falls, if you are invested on the longer duration debt funds, you will be able to take the advantage of this interest rates going down and create a return of around 11 to 13% in a debt product, which generally ranges from a 6 to 7. At this point in time, if you invest in an FD, you might get a 7% return. So this is an alternative which we are placing against a FD. If you are placing a FD for 7%, if you want to take an exposure into the long duration debt basket, you might get a return of 11 to 13%, which is equivalent to a large cap portfolio on a long term basis also. So this strategy is on a tactical basis for a good 2-year period, expected return of 11 to 13% of CAGR pre-tax. So that's the portfolio. And if there are any specific questions about it, we can help you understand it better. You can just reach out to us. We'll be able to help you with the portfolio and the construction which we have done before on it.
Sure. Yes, we have released few videos, and I think we also have some presentations that are there. Last question I've already got, so I'll just stop post that. So this is from Pradeepa. Pradeepa has asked this question saying, is seasons flavor basket, should one be, is there an option to invest in lump sum only, or do you also have both lump sum and SIP? If Mohit, if you want to take that.
So we have a investment here in lump sum form only, primarily from a point of view that seasons flavor will tend to shift strategies. Today it might be manufacturing infrastructure, tomorrow it might be something else. So it's an investment primarily in the lump sum from a lump sum point of view, and the minimum out here is 25,000.
Okay, so no, so no.
No SIP.
Yeah,
No
Pradeepa, there's no SIP because, as Mohit was saying, the expectation is that there will be a lot of churn in the portfolio. What worked today may not work after 6 months or a year or so, right? So there will be a lot of movements here and there, and that's the reason why we don't want to do any kind of an SIP. The minimum amount is just 25,000 rupees, and it will get invested. And whenever there's a need for a change, for example, today you invested in election as a theme, and we believe if the theme works out in the next 6 months, we may change it to, just for an example, we may change it to consumption, just for an example, right? Now that we have changed it to consumption, so we will sell the funds that you have bought in the, I mean, you have to approve it. We will rebalance it with your approval, saying sell something and buy the other funds also. So we'll keep doing this at a regular interval. And that is the reason why we do not want to do any kind of an SIP in this fund in this basket as a concept. Of course, if there's any changes, we will let you know. But at the moment, there is no SIP in this. So I think we have answered all the questions. I don't think there are any other questions that are pending. Of course, if there's anything more, please feel free to write to us. The email ID is hello@mira.money, MIRA.money. Plus, you can download the app. Now, if you've understood it very clearly, just download the app, complete your KYC, make sure your KYC is validated, invested, and the fund starts working in 3 simple steps for you. please do reach out to us on LinkedIn, on other platforms, and we'll be available to help you. I think with this, we come to a conclusion. Naveen, if you want to add anything, or we are good to end the presentation.
No, I don't have anything to add. Yeah, just to let you guys know, in these portfolios, we will be watching it closely, and we'll be actively monitoring and managing them.
Absolutely. Got it. So, thank you, Mohit. Thank you, Naveen, and thank you all of you who could join in today on a weekday, late evening. And I hope to see you all soon. And have a good week ahead. Bye bye.
Thank you so much.